Welcome to part two of our two-part series on exploring employer-sponsored plans. In this lesson, we're going to be looking at defined benefit plans. In this lesson, I'd like to help you understand the difference between a defined contribution plan and a defined benefit plan. I'd like to show you how a defined benefit plan works and give you an example. Then we'll explore how a cash balance plan works and the added benefit. Then we'll take a look at layering in a 401k with a cash balance plan. Lastly, we'll explore the pros and cons of the defined benefit plan, how to set them up, and what are the annual commitments. So let's take a look at the defined contribution plan and a defined benefit plan. We'll look at how they are similar and how they contrast. The easiest way to think of a defined contribution plan is a 401k, where a defined benefit plan is more like a pension. Within a defined contribution plan, as the name alludes to, it's designed to provide the employees with a specified contribution amount per year. As we spoke in the lesson, the employer-sponsored plans, the defined contribution, you saw that like 401ks, for example, had an annual contribution limit. The terms of a defined contribution plan determine how each employee becomes eligible for a share of the contribution and how the contribution is then allocated among the eligible employees. An employee's interest in the plan is expressed as an account balance. What that means is if you look up your 401k online and you see the account balance, that is a reflection of your contributions plus investment performance. An employee's retirement benefit is defined in a defined contribution plan is simply determined by the total contributions to the employee's account and the account's investment performance over time. A defined benefit plan, again, like a pension, the contribution limits of a defined benefit plan are expressed as an annuity beginning on the employee's retirement age and is payable for life. The calculation and the way that this works is the closer that somebody is to retirement, the more that will be funded into the defined benefit plan. Rather than expressing the employee's interest in the plan as an account balance, the employee's interest in the defined benefit plan is generally expressed as in a monthly annuity beginning on the employee's retirement age and is payable for life. Employers provide employees with a guaranteed benefit to be paid out in retirement. And the investment risk of a defined benefit plan falls solely on the employer. So let's take a look at a defined benefit plan a little deeper. Again, I want to remind and dig deep on the differences that we spoke about in the earlier slide, in that a defined benefit plan promises to pay an employee a specific monthly benefit payable when they're in retirement. A defined benefit plan is usually funded entirely by the employer. The employer is responsible for contributing enough funds to pay the promised benefit regardless of profit and earnings. So whether the company is profitable or not, it is still obligated to make the defined benefit plan work for the employees. Again, rather than expressing the employee's interest in the plan as an account balance, the employee's interest in a defined benefit plan is generally expressed as a monthly annuity beginning on the employee's retirement age and is payable for life. So let's take a look at the mechanics. Actuaries are required when using a defined benefit plan. The actuary will determine the yearly employer contributions based on each employee's projected retirement benefit and assumptions about investment performance, years until retirement, employee turnover, life expectancy at retirement. Employer contributions to the fund are promised benefits are mandatory. Investment gains or losses can cause the employer contributions to increase and decrease. Non-vested accrued benefits forfeited by terminating employees are used to reduce the employer's contribution. So let's take a look high level at what this means. I'm going to assume a one owner, one employee participating plan, i.e. the employer is the employee. So it's a business owner who is also an employee, and there's no other employees. And let's say that they are 10 years away from retirement, and the IRS says the maximum benefit that can be allowed is $2 million. So if we do the $2 million divided by the 10 years until retirement, the max funding is $200,000. So in this example, the company could deduct $200,000 to the defined benefit plan. And then on a yearly basis, the actuaries come in and take a look at investment performance and how close the employee is getting to retirement. So let's say that the investments do tremendously well and there's a 30 or 40% return, and we're looking at year 2. That would actually be a positive to the plan, but it would be negative to the employer because the benefit, the amount that's been funded to the plan has grown and the benefit has stayed static. So in year 2, if performance of the investments is done quite well, will actually reduce the employer's obligation. But on the flip side, if the investment do poorly, it would actually increase the employer's responsibility to fund the plan because the plan assets have gone down year over year and the obligation still remains. Let's look at a detailed example, and actually one that I've done with a client. This client was a small business owner in their 50s, had about 15 years to retirement, and the business was profitable. It was more profitable than ever. It was around $1 million of net income. And we knew that it would continue to last for 5 years. There was only one other employee, including the owner, who was considerably younger than the owner. Since the owner was in his 50s and relatively close to retirement, he was allowed under the rules to make a pretty high tax-deferred retirement contribution to the defined benefit plan. Based on the actuarial calculations, the business owner was able to make a maximum allowed contribution of over $230,000, and a majority of the contributions went to his benefit. And in examples that I've seen, it's not uncommon for an owner to be able to save between $100,000 and $300,000 each year, depending on their age and when the plan is started. So let's take a look at a cash balance plan. A cash balance plan is still a defined benefit plan. But in recent years, many employers have chosen to forego the traditional defined benefit plan for the hybrid cash balance plan. Cash balance plans are subject to the same funding, retirement, operations, and benefit limitations of traditional defined benefit plans, but they look and feel like a defined contribution plan, primarily that the benefits are expressed as an account balance. But there is still the guaranteed fixed rate of interest and are not subject to market fluctuations. The way this works is each participant has a hypothetical account balance and no assets are segregated or separately invested for the participant. Each year, the hypothetical account has an amount credited to it as a percentage of the participant's salary or fixed dollar amount. Each year, the account also is increased by the interest rate specified in the plan. The hypothetical account continues to increase in value until the participant is entitled to a payment. At that point, the hypothetical account is recalculated based on the actuarial assumptions specified in the plan into an annuity form of benefit. If the plan permits a participant to elect a lump sum benefit with the appropriate spousal consent, the lump sum payable should equal the amount of the participant's hypothetical account balance. Where I've seen this is, again, going back to the example of the client that I was working with, when the plan would be terminated, it would be distributed into 2 separate IRAs, one for the employee and one for the employer. So let's take a look at layering in a 401k with a cash balance plan. This is a true state-of-the-art in plan design for owners of small businesses with staff. When the cash balance plan is coupled with a new comparability 401k profit share plan. This approach allows the owner to benefit from a higher deduction provided by the cash balance plan while retaining the added flexibility of a defined contribution plan. So the way that this works is a new comparability plan is the profit sharing plan for the 401k, and sometimes referred to as cross-tested plans, are usually profit share plans that are tested for non-discrimination as though they were defined benefit plans. Certain employees may receive much higher allocations than they would be permitted by a standard non-discrimination testing. New comparability plans are generally utilized by small businesses that want to maximize contributions to the owners and highly paid employees while minimizing contributions to all other employees. So what does all that mean? Employees are basically divided into two groups, owners and non-owners. Each group receives a different contribution percentage. For example, higher contribution percentages may be given for owner group than non-owner group, as long as the plan satisfies the non-discrimination requirements. So what are the pros and cons of using a defined benefit plan? Some pros are it allows for superfunding of retirement accounts with sizable tax deductions. As you saw in the example that we went through of the client that I'd worked with, they received almost $230,000 of tax deductions that went primarily to the benefit of the owner. The business has some flexibility on the contributions to the hypothetical accounts. And then if the plan is covered by ERISA, the plans are generally fully protected under federal law from the claims of both your employees and creditors, even outside of bankruptcy. Some cons are the administrative costs can be pretty significant, and I'm going to add in there that the administrative burden, some of the paper pushing, is also an additional weight to be carried. For businesses that income fluctuate annually, the business may not have the cash flow to fund the program in some years. And under a defined benefit plan, the employer sponsor is responsible for paying the pensioners. The employer assumes legal responsibility for the defined benefit plan ability to meet the contractual payout. If the underlying fund has a shortfall, the pensioners become creditors of the company. So how do you set up a plan and what are the annual commitments? I recommend starting by hiring a third-party administrator. We spoke about those in the 401k section, also known as a TPA, to help design the plan and get the ball rolling. They would draft the defined benefit plan document that meets the goals of the plan or the owner. Then you would need to select a trustee and then adopt the plan. You would begin making contributions, which are calculated by an actuary at the TPA each year, and those contributions, annual contributions, are due with the filing deadline of the business tax return, including extensions, very similar to the SEP IRA. And then start investing the plan's assets in a diversified mix of investments. Then make sure that the record keeping, administration, testing requirements, plan documents are all completed and submitted annually. The cash balance plan and the defined benefit plan also require a Form 5500 similar to a 401k. Some added things to think about that I've experienced in working with clients with a cash balance plan or defined benefit plan is an annual census will need to be completed for the TPA to support the plan. Basically what that is just employee data, when they were hired, possibly terminated, dates of birth, and compensation. I've seen ERISA bonds that are required for these type of plans. And then also there is some annual filing with the Pension Benefit Guaranty Corporation, or the PBCG, may also be required. So this concludes part 2 of the employer-sponsored plans, where we've taken a look at the defined benefit plan. I appreciate you being with me. Thanks a bunch.